Okay, now we're on measurement models, right? We spoke of initial
Yes.
measurement and then subsequent measurement, and they said that for subsequent measurement, the cost model is just the same as for. And then for fair value model, we just compare it to the revaluation model by 16 PPE, right? The first point,
Yes.
an asset should be revalued at the end of its reporting period. This is fine. At least at the end of that, it's fine. Even before even the frequency, if the frequency increase is no issue. But after initial recognition, right? If you revalue one item, it means all of them must be what? Must be revalued.
Revalued.
Yes, yes. That's what you have to do, right? In case maybe you cannot get the fair value, then you have no way because if you can't get the fair value, you can't do that. So it's fine. You can apply the cost model because the fair value is not there, right? But it is not appropriate to just
Okay.
switch between measurement models, right? You do that because you have no choice. And also here you're
Okay.
told that again all loss arising from changes in the fair value of an investment property should be recognized in what? Profit or what?
Net profit and
You see
profit
how
and
easy it
loss.
is? Yes. For revaluation mode under 16,
Okay.
again goes to other comprehensive income, while loss goes to profit or loss. While here, everything goes to profit or loss. Of course, we
Loss.
learned the complications of reversals of revaluation gains and losses there, but here we don't have that because everything should be going to profit or what? Or loss and then retain gains.
Loss.
Yes. And then the fair value of the investment property should reflect the market conditions at the end of the reporting. This is just normal. Any fair value of anything you put must reflect the reality. Yes, right. The main point is here,
Okay.
which I said very early. Depreciation should not be what? Charged.
Charged.
So when you compare the fair value model against the revaluation model, revaluation charges depreciation, while fair value model, no depreciation. For evaluation,
Yes.
the gain goes to OCI, while for fair value model, whether it's a gain or loss, everything goes to profit or what? Or loss.
Loss.
Right.
Okay.
Yes. So you can have such kind of complexity. Yeah, that's all about this. Maybe let's just look a bit more on some additional matters, just normal matters. They are also normal, but
Okay.
sometimes we just need to have a certain sprint. As I told you, we need to finish this 14. Okay? So, but
Yes.
if you get tired, let me know. Let me know. Let me know.
I'm into it.
Okay, that's good. That's good. Okay. Okay. Now,
Yes.
let's
Yes.
changing what? Changing model. When we say changing model, you say you have cost model and fair value what? Model. Then,
Model.
are we allowed to change models as we wish, or are there principles to follow? That's what we are on about. That's why you say once the entity, simply speaking, fair value model, we expect fair value model to be better than cost model, right? Because if you say it's fair value, it
Yes.
reflects the reality. Yes. That's why you say once the entity has chosen a fair value or cost model, it should be applied to all of its investment property. That was the obvious. We said it before, right? That if you revalue one, you have to revalue all. You can say some one set use cost model, the other you use fair value what? Fair value model because they are all belong to the same class, right? So
Yes.
no point there is just the same as above. And then we say back that you should not change from one model to the other unless that's you don't change as you wish, unless the change will result in a more appropriate what? Presentation.
Presentation.
Now, in reality, if you have switched from fair value model to cost model, it would be very unlikely that switching back to cost model would be more relevant. That one would very be unlikely, right? That's
Yes.
But switching from cost model to fair value model is very likely. It makes a lot of sense. Okay, let me switch from cost model to fair value model to actually to be more. Hello? Okay.
Yes.
Okay, so that's what we do. And then I think we are finishing about the last point. Transfers to or from investment what? Property.
Property.
This two is just normal too, but we just need to understand what we need to think about. The investment property is land or building. And as you have seen, this is IS what? 40.
40.
But you never know. We said that if it's unoccupied, we use IS what? 16.
16.
If you make it for the purpose of selling, use IS what? IS 2. So
Two.
something that was once an investment property may decide, okay, now it's unoccupied. Maybe the tenants have left, they have decided to stay myself, right? It's now unoccupied.
Yes.
I, as a company, we as a company
Okay.
have decided to stay ourselves. So it's no longer an investment property. I now have to apply PPE I-16, right?
Okay. Yes.
So it really depends on the situation that will be there. That's why we speak of transfers now. So you may be switching from investment property to PPE or inventory, or you may be switching, let's say, from inventory to IS-40 or IS-16 to IS what? 40, investment property.
40.
What are you going to do?
Okay.
The simple matter, without even speaking anything, is you have to get done with the standard we are using, right? If we are using a 16 PPE,
Okay.
get done with everything there and then switch back to the new accounting standard that we'll have to be using. That's all the principle is, right?
Oh, okay.
Yes, that's the main principle. So we'll see a lot of words here, but that's what we're going to do. And also, it depends on the models we are using, right? For example, maybe if
Yes.
you are using, the cost models are usually, you should go for cost model. There is no fair value to say that maybe you have the gain or loss. No. So under the cost model, there is actually nothing to do, right? Because if an item has
Yes.
a carrying amount of 20 and I'm just changing it from investment property to PPE, I'll just switch the same figure 20, right?
Yes.
Maybe from then on, I'll have to apply principles of what? I-16 instead of I-40. But there won't be any gain or loss.
Okay.
It will be just the process of, let's say, okay, maybe I had an investment property of 40. I need to remove it, right? Since it's an asset, to remove it, I'll have to credit investment property by 40, right? And then at the same
Yes.
time, I'll say, okay, this is now PPE. So I'm going to debit, and I say what? PPE, I say how much?
PPE
40, yes.
40.
So debit and credit will have balance, and you will have to do, and you have nothing to do there, right? But
Yes.
now, the significance of these transfers comes when we apply the what? When we use the fair value model, when the fair values are actually involved. That's why in the cost model, I just told that investment property, cost model investment property will lead to no what? No changes in that, in the carrying amount. And so, if this is the case, there would be no gain or losses on the change, right? But
Yes.
now we go to our point. Our point is on what? Fair value model.
Okay.
Okay, let's read now. We'll see what everything that I told you, that you deal with the previous application until that point, and then from then on you start applying the what? The new standard. For example, now
Okay.
when there is a transfer from investment property carried at fair value, of course we are on the fair value model, so it's always at fair value, to unoccupied property or what? Inventory. When we are
Inventory.
changing from investment property to unoccupied or inventory, it means I'll have to recognize that carrying amount and recognize the new one, right?
Yes.
So what are you going to do? You're saying the property's cost for subsequent, wait, the property's cost for subsequent according to according accounting under 16 or 2 will be its fair value at the date of what? Of change of use, and the gain or loss
Change.
will be taken to the statement of profit or loss. What matters is this point here. Because when we do change and we have fair values, we will have either gain or loss. Where are you going
A
to
lot.
take it? Yes. And that's why I told you, if you had the investment property maybe at 40, I'll have to remove it by crediting, right? Investment what?
Yes.
I'll say,
In-
let's do this.
Investment property.
Yes, so I'll say credit investment property by how much? 40. And then let's say I'll be recognizing, let's say it's PPE or maybe it's inventory, whatever, right?
Inventory. Yes.
Let's say now you recognize it at first, you recognize it by that figure. And actually, what you have to do now, before doing that, I need not, I need us to go to that principle now. Yes, right. I told you that since we are using investment property at fair value, you have to restate it by using the same IS-40, after which you will then have to change it from investment property to PPE or what? Inventory. So
Inventory.
if you revalue it, let's say maybe you had the investment property at 40. I would say that, okay, maybe the value has changed. Maybe it has changed from how much? It was 40, but now maybe it's 40, 40 how much? 42. Its fair value. It's now 42. It has increased by how much?
2.
By 2. So I would say, okay, so my, of course, I'm changing, but first I respect it and I treat it as by investment what? Property. So I would say debit investment what? Property by 2, increase it by 2, right? And the corresponding side should be the gain, right? Because it
Yes.
is increasing, yes. Gain, which we said it goes to
Yes.
profit or what? Or loss for investment property, right?
Loss.
Yes. Gain of how much? Of 2.
Yes.
After getting this now, you say, okay, it's
2.
fine now. Investment property, I'm not switching to PPE or inventory, so I'll no longer obey to your rules, right? It's time to say goodbye now.
Yes.
You say goodbye to investment what? Property. Then you say, oh, goodbye, Mr.
Property.
Property. So I credit investment property from my books. Remember now it will be having an amount of 42 now because we had 40 and we have increased how much? 2 in your book.
42.
Yes. So I would say credit 42. Okay, what comes in now? It may be PPE or let's say
PPE or
inventory.
inventory.
Yes. Now because already I've already used the amount of 42, I would say okay, I have my 42 there. So if you do this, it will look like this is what should actually be done for you to understand why this gain goes to profit or what?
Loss.
Or loss. To understand why it goes to profit or loss. That's why I've done like 2 double entries so that you understand, right? Yes. So after
Okay.
this point, everything would be fine. But someone else could have said this way, okay, since maybe you have already understood, someone could say, okay, now I'm not going to do double entries twice. He would just say, okay, just remove the investment property that was at 40 initially, right?
Yes.
Just say, okay, just remove the investment property, which was at 40, at 40. After removing it at 40, okay, we are recognizing something new, right? Let's say it's the PPE or what? Inventory, but the new fair value equals to 42, right?
Yes.
And so we say the balancing figure should be on the credit side and there should be what? The gain of how much? Of 2. So
2.
this entry here has incorporated all these two, but I did these separately to make sure you understand why this gain goes to profit or loss despite switching from investment property to PPE, which uses revaluation model, and the gain under revaluation model goes to OCI. But here we use the profit or what? Or loss. So
Loss.
when you are in an
Okay.
exam and you are just trying, okay, I need to save time, you can just do it this way, but you bear in mind that okay, I know what I'm doing. This gain should follow the principles of the previous standard, right?
Okay.
Yes. After doing it initially, then from here onwards, if you are using PPE and the evaluation model, whatever gain should go to other comprehensive what income. But after doing this,
Income.
right?
Okay.
Yes, I hope
Yes.
I've got that.
Yes.
Okay, now can just do this. Okay. Now you see this. So whatever explanation you see here, I hope you should expect what to see, right? Look here. An owner
Yes.
occupied property, which is usually 16, may become an investment what? Property. What are you going to
Property.
do? If you are changing an owner occupied to investment property, it means previously if there were gains, we are taking the gains to what? Revaluation.
OCI.
Yes. So even if you are changing to investment property, at the time of conversion, you need to obey the principles of IAS 16, right?
Okay.
Then
Okay.
after that, you start obeying the principles of what? Investment property, just like that.
Investment property.
Yes.
Okay.
So you won't need to worry. So now I need to simplify matters. Now I'm not going to do the double entries twice since I first wanted you to get why we do that, right? So this is what I'm going to do. I
Yes.
would say, okay, I had my PPE, so I'm crediting my PPE. Maybe in the books, even before the revaluation, I had the PPE at how much? At 40. But
At 40.
now I'm switching to investment to what? Property. But the fair value,
Property.
let's say, is now 42. Okay. You find that you have the balance on what? On credit or debit? Credit, right?
Debit. On
Uh,
credit.
and okay, so you have to, there's a suspense on credit. So you say that since it's a credit balance, the value has increased, so it's a gain. But this gain now goes where?
Other comprehensive income.
Excellent. That's a comprehensive income because we obey what? I-16 PPE. That's where we
I-16.
are switching from. Yes. So I'll have my two there. Now you see. I hope now you got it. You get it, right? But this is just at the
Yes.
just after doing this, you start obeying investment property because you have said farewell to what? To PPE as what? 16. Right.
Okay.
Yes. So that's why
Yes.
even when you do look at this explanation, that's what we're going to see. An unoccupied property may become an investment property and need to be carried at fair value. An entity should apply what? I-16 after the date
I-16.
of change of use. And then it should treat any differences that at that date between the carrying amount of the PPE and the fair value is a revaluation and is what? 16. So it's very simple.
16.
Yes. Just prepare to do the proper farewell, right? To the standard
Yes.
that we are using previously. Right. Just like the normal,
Okay.
just like the normal farewell you should be doing in life. So
Okay.
now we are changing, let's say, from inventory to investment property. Now this is, inventory doesn't have any complication. There are no, I don't know, this revaluation models or what. Inventory, whatever changes in inventory goes to profit or loss, right?
Yes.
Inventory is too so you won't even need to worry. Investment property, you just do like investment properties for inventory. So inventory changes to investment property. If there are those changes, we should also take the gain or loss to what? To profit or loss. So the better thing here was from investment property to PPE and from PPE to investment what? Property.
Property.
Being careful when you are just changing. Just like that.
Okay.
Whatever remains is nothing. The recognition, whatever non-current asset you recognize, you need to get the gain or loss on what? On disposal. Right?
Okay.
Yes.
Yes.
Let me ask you one thing. Have you ever tried the have you ever downloaded those past exams of diploma in FRS?
The ones that it's only the kit that I shared with you. It's mixed with SBR.
Okay, okay, that's fine. I wanted to do one thing. There is I usually not like to use BPT, but there is one book I once downloaded.
Okay.
One book I once downloaded is to BPT. I think it should reach a time. Can you see my folders?
No.
What do you see now?
The from where you were explaining
Okay, so you see that document. Okay.
materials from, yes, from where you explain.
So for that, there is a moment. Please download that. This is for 2015, 2017. Okay. I just have this one. I just have this for 2019. I think after a week you should start. What can you see now?
Now I'm seeing diploma in international financial reporting,
Yeah.
Friday 7th June 2019.
Yes. These are the things you should sometimes, after some time, after you've studied a bit, you should be going through this. Sometimes it helps your study process, right?
Okay.
You can see
Yes.
what you can find. For example, they like a lot to use these words, these names, alpha and beta. Here they're speaking of
Okay.
subsidiaries now. Okay, alpha is one subsidiary. I don't know what they are giving the statements here. You know, sometimes to get used to know. What is
I always get lost when like they've given a lot of information. I don't know how to really go about it. If you start with the question, or
yeah, yeah, yeah.
I can understand at the beginning, but then I get lost in the middle.
Yes, to avoid that thing, you have to learn that habit of knowing. For example, when there are some people, when you're teaching some people, you find that maybe you have to prepare the financial statement. You have the trial balance and you have the additional information. You should have the way to follow. If you have the principle to follow, you won't get lost, right?
Okay.
Yes, but if you do it randomly, it reaches a point. If you do everything partially, it will reach a point you won't even able to remember. You won't be able to remember whether you did this completely or not. So you would find doing the same
Okay.
thing multiple times, and that happens. That is normal, right? If you do it that way, but there are ways
Okay.
that we can use to know that I'm done with this or I'm not done with this issue. So we'll see about that.
Okay.
No, no worries. Yes, yes. You can see, for
Okay.
example, they're speaking of this. They are speaking of the non-current assets. I don't know, but this is on consolidation. Let's just let it be. That's why I'm saying I'm seeing the standards here. You can see. That's why. Let me show you something. That's why I told you that you have to do them together. This is on consolidation of financial statements, right? But you can
Yes.
see the standards: plant and equipment, that is PPE, brand name, intangible assets,
Yes.
contingent liability I-37, provisions, contingent assets and liabilities, right? You see the impairment review
Yes.
I-36. So those are the things. If you do study them, it would be very easy going forward. Research and development. This is intangible assets I-38.
Okay.
Yes. So this is just lease sale and the lease back. This is the
Okay.
I-21 effect of changes in exchange rates. Of course, it's just a short standard. So those are the things you should expect. So at this point, maybe if I spot a question that you can do, I'll tell you, okay, you have to try that question.
Okay.
Yes, it helps. It gives you confidence.
Yes, it will. It will really help me as well to see how the questions comes in the exams.
Exactly. Okay, so let's go back. So as for the recognition, it's just easy. Whenever you recognize something, right?
Yes.
You have to whenever you dispose of something, you have to recognize it and get the gain also on what? On disposal. And as I told you, the money you obtain from disposing it, do not consider it as revenue, right?
Okay.
Yes.
Yes.
So any gain or loss on disposal is the difference between the net disposal proceeds and the carrying amount, just like that. Oh, that's fine. Maybe you're just trying to specify something else, but also it's not so important here. The standard, which is a compensation from third parties for investment property that was impaired. You may have leased out your building to someone else, but maybe they did the damage, right? If they
Okay.
did the damage, when they provide back, maybe you're just disposing, and maybe you are speaking of the compensation from those third parties. How should we treat them? That's why you say compensation from third parties on the building that was impaired, lost, or given up shall be recognized in profit or loss when the compensation becomes what? Receivable. Just like that, right? Okay, and
Yes.
last now we'll speak of disclosures. Disclosure, it's nothing. Okay, so disclosures, even if you're forgotten in an exam, you just write whatever you know about that standard. Because whatever you do apply, you
Okay.
will have to show it in the book, right?
Yes.
Yeah, that's why you can say, I don't know the choice of fair value model or cost model. Are you using fair value model or cost model? Maybe criteria for
Okay.
classification as investment property. Why are you saying this is an investment property and not PPE maybe
Okay.
or not inventory? Assumptions in determining fair value. For fair value, usually some independent valuers may be taken, the experts on getting the fair value, because I don't know in the same company there will be the person who is responsible for getting the fair value, unless maybe we are dealing with a company that deals with assets which only require fair value and which fair value matters too much. Maybe someone will have been hired especially for that.
Okay.
Maybe you can orchestrate it. specify maybe the rental income and expense. Simply speaking, whatever you do, you can just specify them. And the last point now on these disclosures, the ratio fair value and cost what? Cost model. If an entity has adapted fair value model, it must disclose a reconciliation of the carrying amount of the investment property at the beginning and end of the what?
The period.
For the period. That is normal too. And then for the cost model, I think you also specified that the cost model will deal with depreciation, but the fair value model has no what? Depreciation. That's what I'm saying. It will
Depreciation.
be just matters which are normal. Because when dealing with questions, we will have depreciated. So you will obviously have disclosed just by showing the workings in the notes to the financial statement, right?
Yes.
Mhm. The most important point on these disclosures is here, down here. See, like I told you before, fair value model is expected to be better than what? Than cost model.
Cost
So
model.
if you are using the fair value model, if you're using the cost model, you have to disclose the fair value of the investment what? Property.
Property.
If the stakeholders find a significant difference between cost model and fair value model, they would ask, oh, I don't understand you. You are using the cost model, but I can see a huge difference between the cost, the carrying amount, and the fair value. Why shouldn't you change? So it is disclosed so that stakeholders exactly know that, okay, they are using cost model because there is not much difference with the fair value model, right? That's what they are using.
Okay.
Yes, so that's why it's essential.
Okay.
Yes, when disclosed. Having said that,
So is this fair value, are we going to disclose it in the notes?
okay, yes, this one, yes, we have to disclose it in the note. When someone
Okay.
reaches, maybe you have note one, note two, note three, and when you reach there, you have to specify. Right.
Oh, okay.
Okay, now you have the questions, for investment property, it's just very normal questions. Let's just look at the questions at A and at B. At A, I think it's just about the words, right? Now you can see the importance of also understanding. If you do understand, you can just write, define investment
Okay.
property under exposure and explain why its accounting treatment is different. Different because we say that it generates cash flows that are largely independent of other assets. So, right, explain how the treatment of an investment property carried under the fair value model differs from an owner-occupied. You could explain, right?
Yes. One of them is
Mm,
the gain is for the owner occupied property. The gain is transferred to the OCI,
yes,
and while the investment property, the gain or the loss, we transfer them to profit and loss. So that's one of the difference.
yes,
And the owner occupied property, the revaluation we use actually depreciation, but the investment property we don't use the depreciation.
exactly.
So
You
those
have,
are the differences between the two.
yeah, that's right. That's right. That's fine. That's very fine. So you should remember well on that. It seems that you are very careful. You have intended. You have a real intention. Okay, now let's go to this question. It says, speculate on the following properties is at 1st April 2012. Property A, you have property A, which says an office building used by speculate for a administrative work purpose
Okay, plus this
with a depreciated historical cost of how much? $2 million, right?
2 million.
First of all, until here, without going any further, how would you classify this building? Is it classified under 16 or is 40?
IAS 16,
Because of the word what? Administrative.
administrative
Yes.
purpose,
For
and
I
the word
40,
depreciation.
nice. Do not say the word depreciation. Under IAS 40, you can use the cost model or fair value model. If you use the cost model, you do the same as A16. You also depreciate.
Depreciation. Yes,
Yes.
yes,
You
yes.
see
You're
that?
very right.
Yes.
Yes,
So it works
yes,
at the
yes, yes.
purpose for administrative what? Purpose.
Purpose.
Yes.
Yes.
Okay. And now here we are told at 1st April 2012, it had a remaining life of how many years? 20 years. So it's
20
fine. You
years.
have the cost here. We have the remaining life. After reorganization on the 1st October 2012, it's like 6 months later, right? From April to October,
Yes,
the property
yes.
was led to a third party and reclassified as an investment what? Property, applying
Property.
calculate policy of the fair value model. You see now? That's what we just spoke about.
Yes,
Change of views, right?
yes.
And actually, maybe if you use the fair value model, it will be fine because if you use the cost model, you said there will be no gain or loss, right? But you are told that we will be using the fair value what? Fair value model. Then an independent
And
valuer assesses the property to have a fair value of what? 2.3 million at 1st
2.3
October
million.
2012, which had risen to 2.34 at 31st March 2013. Okay, the year starts on 1st April and so it ends on 31st what? March. So at the beginning of the
Okay.
year, it was PPE. 6 months into the year, it changed to invested property and it stayed the same until the end of what? Of that particular year, right?
Yes.
That's fine. And then you go to property B. Property B says another office building sublet to a subsidiary or speculate. Will sublet to a subsidiary of what? Speculate. So speculate had a
Speculate.
subsidiary and so he let the subsidiary stay in that same building, but he sublet it. So it was like he himself had leased it, but he sublet it. So it is an investment property, right? In the individual in the
Okay.
individual book. At 1st April 2012, it had a fair value of 1.5 million, which had risen to 1.65 at the 1st March 2013. Okay, what are we required to do? Prepare
Yes.
the extract from the speculative entity statement of profit or loss and other comprehensive income and statement of financial position for the year ended at the 1st March 2013 in respect of the above property. Okay, so we just need that. But also are told in the case of property B only state how it would be classified in speculative consolidated statement. When I told you before, I told you that uh, there is this issue between parent and subsidiary. If you provide the building to a subsidiary, it's normal. You say, okay, it's an investment property, right? Very well.
Yes.
But now, in case, let's say you have done something else, right? Let's say you are going to consolidate the books as a single economic unit. You would have to treat it as own occupied what? Own occupied property, right?
Okay. Property.
Yes. So that's what we are going to do here. This is just the extract. You have to go to the website. Investment property is very direct. Yes, it's actually done right away. Investment property, you don't have to have it all. Okay, it's fine. We know that we have property A and property B. Property A,
B.
you had the cost of this is causing problem. Hello,
Yes.
let me deal with someone is causing problem. Like 1 minute, 1 minute.
Okay. Emmanuel, come here.
Hello.
Hello.
Okay, let's just proceed. So this is what we are going to do. You had the cost of 2 million, right? Of course, it's a depreciated cost, but since you have the remaining life, we will treat it as our new cost, as our deemed cost. So you have to get the depreciation for the first 6 months, right? Because you get my point. Hello.
Hello?
Yes.
Yes?
So you had the cost of 2 million, right? And actually,
Yes.
we have not been provided with the residual value, right? So you have this cost of two
Yes.
million. It would have you would have to depreciate it to know the depreciation for the year. But remember that after 6 months, you are going to change it to use the fair value model. After which you do not have to apply depreciation. So you first get the depreciation for the year, right?
Yes.
So you say 2 million divided by how much? By 20, right?
20.
Yes. This one will
Yes.
be the depreciation for the year, and then you have to multiply it by 6 over what? Over 12, because we need the depreciation only for 6 months, right?
Okay.
Only for
Yes.
6 months, yes. After getting it now, as you can see here, 2 million over 20 times 6 over 12, you have this shift there. This one will be the depreciation after 6 months, right? So
Yes.
we'll have it under profit or loss. And then we now have to get our carrying one, our carrying amount.
Amount.
Remember, we are treating it as CPE. So how do we get the carrying amount? We would have the 2 million minus how much?
Minus. Let me just calculate it. Sorry.
So it's 2 million over 20, it's 100,000. Then this over 12 is 50,000. So it's like 2 million minus 50K, right? Of course, we are holding
Yes,
the three zeros.
100,000.
Yes. So if you do that, you remain with 1.95 million. Or I can just write 1950 and hold the three zeros, right? Just like this.
Okay.
Okay, so after doing this, I'll have the sharing amount. My friend, why are you making noise? Ew. Okay, can you hear me?
Yes, I can hear you.
Yes, we have about 1 minute, right? Let me use this 1 minute to silence someone. Someone has invaded my territory. Let me use this to deal with someone here, and then I'm sharing the link soon, right? We have like 1 minute and 30 seconds, right?
Okay.
I'm sharing
Okay.
it soon, and then we proceed. Okay.